If you're a resident physician or you're in a fellowship program, you can save money in the Public Service Loan Forgiveness Program by knowing some little-known rules with a tax code to lower your adjusted gross income. Why is that important? Because if you lower your adjusted gross income, you'll have a lower student loan payment. Because since the government takes your AGI, that's what that stands for, adjusted gross income for short, if they look at that and they take 10% of that to determine your student loan payment, if that number is lower, then you'll be able to save 10% of whatever the amount that you lowered it by. The first common way to lower your income for the PSLF program as a resident or fellow is saving for retirement. A lot of financial planners or advisors might tell you to take the Roth option for your retirement savings while you're in training because of the lower tax rate that you'll be in. While that might make sense for folks who have no student loans, if you do have student debt, it's a little bit more difficult of a decision to do the Roth. I recommend personally that you go with the pre-tax 401k, 403b, or if you don't have access to retirement plan, traditional IRA. You can save as much as $18,500 if it's an employer retirement plan, and you can deduct that off of your adjusted gross income, which will allow you to have a lower student loan payment if you do the $18,500 max of about $1,850 less a year. That's big savings because the PSLF program forgives your debt tax-free. So anything less that you pay ends up being forgiven, which is basically the same thing as money in your pocket. Number 2 is health savings accounts. Using a health savings account, you could put as much as $3,450 away for your expenses for healthcare tax-free, and then you can have it grow tax-free and pay health expenses tax-free. It's a triple tax-exempt account. If you're married or you have a family, then you could put $6,900 into a health savings account, which is even more money that you can deduct from your AGI and have a lower student loan payment. A lot of residents and fellows are not eligible for health savings accounts, but if you are, you just need to see if you can sign up for the high deductible plan that your work offers, and then if you can sign up with the health savings account administrator that manages the high deductible health plan. You'll get a debit card. You can pay your health expenses whenever you need to with your debit card. It's really a pretty easy thing to do. So that's one of the most popular ways to reduce your AGI and your income, which also helps you with your student loan payments. The third way is something that you should never overlook, and if you're doing your own taxes, hopefully you're doing something like TurboTax that could catch an error like this. But if you have modified adjusted gross income of less than $65,000, you can claim a $2,500 student loan interest deduction. This could save you a lot of money, especially if you're in a state with a high state income tax rate, and it will lower your adjusted gross income and save you money on your student loans too. So the student loan interest deduction is a tremendous thing to take as a resident or a fellow because most people, when they're in training are going to have less than $65,000 of taxable AGI income. So the number 4 way to reduce your student loan payments as a resident or a fellow is to take advantage of capital losses up to $3,000 if you have them. A lot of people are not aware that if you have a capital loss, you can deduct up to $3,000 off of your ordinary income when you have that kind of a loss. Hopefully you don't have this. Hopefully you don't have to deal with that problem. But let's say you bought Bitcoin at $20,000 and now it's down at $6,000 something and you have a big loss. You could write a lot of that off and save money on taxes, which would reduce your student loan payments because the government will see less taxable income. So those are 4 ways that residents and fellows can reduce their taxable income and save money on their student loans if they're going for the Public Service Loan Forgiveness Program. If you happen to be married to a very high income earner, have no desire or ability to go for the PSLF program, then you might look at refinancing as a resident. You can look in my site. There's a lot of links that are cashback bonus links to Splash and Laurel Road, among others, that will refinance your loans as a resident. But I typically suggest that you keep your options open because you never know what will happen as an attending in terms of qualifying for the PSLF program. Hope you get out there and reduce your taxable income and save some money on your student loans because heck knows you have better places to spend it on when you're working 80 hours a week at a hospital. Thanks for watching.